Guys, welcome back to the Independent Investor Channel. Great to be with you. This is the home of the self-directed investor tutorial. I roll these products out to provide visibility to the subscriber base as to what is possible as a self-directed investor. We do this periodically through the channel so you guys can kind of see how the portfolios are working. In this video, I'm going to drop you into the Roth IRA account number one. It really is the flagship account that I own. It is the self-directed Roth IRA account. We'll see how the account is performing here. And let's drop you into the account. We'll start the review. All right, so this will be an opportunity to review the self-directed Roth IRA account number one. This is my account. For you guys that have been with me for a while, I periodically roll out these portfolio reviews to go over any new additions. We'll be going over one new position and one position that we added to this week. These will be the types of updates that I'll roll out through our self-directed investor group. But for the periodic reviews through YouTube, I average about once every couple weeks to roll these portfolio reviews out for you guys and just kind of know what I'm holding, what my philosophy is over this account. This is a dividend growth strategy with some passive ETFs within the portfolio. My largest position here is VYM, complemented right below that by the VYMI. So those are the two larger total market, broader ETFs that I do own. I did liquidate out of emerging markets this week, so I did sell that for a profit and liquidate that, put that to cash, and actually used that to enter into some specific chip exposure in Qualcomm. So that's the newest position that we've established here at 30 shares. Total position 2,775 at the time of filming this. I think my entry was just a touch less than 92.51 at the close of the market last week. So not a whole lot has changed in the portfolio. Some highlights for you guys to understand. You can see how some of these positions are maturing as they get larger and continue to pay dividends. That's exactly what we want. I don't do a whole lot of maneuvering in this account anymore. I allow these positions to grow over time, and we'll continue to grow these from year in and year out as we fund this up every year. But the top holding here is Boeing. We entered into that position at 220. We rendered a lot of profit on Boeing within this account. It's just an ill-advised entry, to be honest with you. I didn't think the stock would go below 200 again, but it did. And we'll continue to hold these shares long in Boeing. Citigroup here. And that's been a long holding of mine in financials. Been a real underperformer. Financials has just underperformed the overall market. And Citigroup in this portfolio has been somewhat of a drag. And next is Caterpillar out of the industrials. 25 shares, little over anyway, just a slight little dab of underperformance there. Disney here, one of the cornerstones in the portfolio, has obviously not fared well through the pandemic, and we'll just continue to hold on those shares as well. I think you guys are going to find a theme in this portfolio right now with the holdings being as recessed as they are. And certainly they've come a long way from the bottom in late March, but we've still got some work to do, and I'm continuing to hold true on these good names. FedEx was really down for a long time, just reported a blowout quarter. It did very, very well. So that's actually, I think we were down significantly more than this. So we're marching back up toward profitability in the FedEx holding long in this account for sure. Home Depot has done really, really well for us. This just a touch here in Home Depot. This is a great long holding for me. I did render profits already once in 2020. So those profits I roll into other aspects of this portfolio. So, you know, when you see a figure down at the bottom here, down 17,551, And don't be alarmed by that. That's the tip of the iceberg. What you don't see is that the vast majority, if not all of it, is house money recessed on positions that were bought free of charge. So if you guys want to know more about my strategic outlook to investing and taking profit, rolling those profits into new holdings, certainly want to join the self-directed investor group. I'm going to be a little bit more forthcoming in that group with some of my specific strategies and why this particular negative figure at the bottom here is nothing to be alarmed about when you're looking to grow wealth long term. So next here, IBM and technology. This is old tech with 25 shares. It's one of the very few positions that I own in two different spots. It gives a great dividend yield in the portfolio. J&J, I've owned this for years. It's actually up right now, one of the few holdings that are. It's definitely a buy here in the low 140s. I think it's extremely attractive right now. J&J, Kimberly-Clark, KMB, also one of the rare holdings that are actually up right now. Everything was down during the pandemic. You're just seeing some of these holdings really fight back to get back to neutral, and they will. In the meantime, we'll continue to render that $800 on an average dividend that my three larger portfolios are rendering, and they're working. They're doing what they're supposed to be doing. So there's no reason to panic when a company like Coca-Cola is down a little bit in the portfolio. It's fine. It's doing what it's supposed to be doing, and that's accumulating more shares within the portfolio. McDonald's, great in the discretionary name. Really excited about owning this long. Nice sizable position at just over 20 shares. Otis Worldwide, this is the elevator maintenance and supply company that was rendered from the United Technologies split and merger. Qualcomm, we've already talked about. That's the newest addition to the portfolio. Royal Dutch Shell, we would really like to add to this position here in the low 30s. This is just an incredible entry here. But I'm choosing to hold true on this with the downturn in energy and the headwinds that the energy sector faces. I just think we'll continue to hold these shares long. Right Smile, again, if that ever takes off, we'll be rich. So that I've owned for about 3 or 4 years now. It's just easier to keep it in the portfolio than try to sell it and render this $50 that I have left in the name. I might as well just keep it, because if somebody acquires it and it goes up, I'll be making a video about how I made millions of dollars with Right Smile, and I'm the greatest investor ever. No, just kidding. This is more of a joke in the portfolio than anything. Raytheon we actually added to this week. We added to this position, I believe it was an 18 share add to Raytheon in this. So happy to do that, and this is not indicative of the real dollars of unrealized loss in this. This was basically just what was effective after the merger. So there was a slight loss in value in the original Raytheon holdings and UTX as those split off. So what was left of what merged with Raytheon was the newly formed RTX here. So VBR, I talked a little bit about that. Small cap value, I don't like this ETF at all. I would just rather own either the VB, which is a blend of both value and growth in here, and live to fight another day. This is just really getting a little bit too cute in the portfolio. My initial thought was to own VB elsewhere at VBK in another location, and this being VBR in this. Honestly, I'm tying up capital here that could be used somewhere else. We're off significantly. This is really just a drag. I don't like it. I wish I could get rid of it. It's an eyesore in this portfolio. It's the only one that I really just don't like. And it's not because it's down. It's just it really has underperformed vastly. And for the lack of quality that this holds, I'm just not a big fan of seeking exposure in this manner. So we'll continue to hold this and hope to get this up to something a little more respectable. VNQ and VPU, those are the specialty ETFs, utilities and real estate, respectively, here. And two of my absolute favorites. What a great way to own these two sectors within the Roth. Both of them pay a nice dividend, and those are working paying dividend reinvestments here. We need the high yield to come back a little bit. Where this is really hasn't done very well in comparison to the S&P 500. So this just needs to continue to work for us. And the final three holdings, Walgreens Boots Alliance here at the bottom, has also just really fallen off, really has not done very good. WP Carey is the real estate REIT that I own in this portfolio. And then finally ExxonMobil here, pulling up the tail here at the bottom, which has just absolutely done nothing but lose me money over the last 3 or 4 years that I've owned it. But we are accumulating a base, and we'll live to fight another day in ExxonMobil. So that rounds out the portfolio review for you guys in the self-directed Roth IRA account number 1. We'll kick you back to YouTube and we'll conclude the video. Thank you so much. All right, guys, so we've come back out of the portfolio review. Hope you enjoyed. Obviously, some volatility going on in the stock market. That's fine. When we do these reviews periodically, you're going to see at times the account is up and at times the account is down a little bit. We're going through a little bit of a hard time right now, so want to be transparent and provide how the portfolio is reacting to the current volatility in the state of the market. Guys, if you enjoy the message coming through, you want to subscribe to the channel. Make sure and leave your comments at the bottom of the video and share the message with anybody out there that you know might enjoy the material that we're putting through from an introductory perspective on the stock market. Bring them onto the channel. We'll get them excited about building wealth for them going forward. Guys, thank you so much for tuning into the message, and good luck in your investment future.